Happy Friday, Melon Heads. I hope you're all enjoying this lovely, lovely bank run week that we've been having since midweek last Thursday. I don't want to say I've been enjoying it, but it certainly got my attention. My God, it has been a week, folks. It has been a crazy couple of days. Been running nonstop, thriving on caffeine. It seems like every few minutes, you get up and you walk across the room, you go get something to eat, assuming I can even remember to eat. I'm actually down a couple of pounds this week because I am forgetting to eat. Well, I finally, get up, walk back, you come back, you made yourself a little sandwich, you sit down, another bank has failed. Oh, great. Or this buyout has happened, or this regulator said this unfathomable thing. It has been that kind of week. So where do we start right now? Not enough. That is the message the market is sending right now. Not enough, J. Powell. Not enough, Swiss National Bank. Not enough consortium of gigantic banks that tried to rescue First Republic yesterday. It's not enough. We're seeing Credit Suisse shares are selling off hard today. First Republic getting clobbered, down a third today. First Republic is down 33% today after rocketing yesterday on the news of their $30 billion rescue plan, which them being bailed out with their own money. Did a video about that last night. Had some truly remarkable, and by remarkable, I mean outright terrifying, over-the-top despotism comments from Janet Yellen at the Senate Banking Committee yesterday, or the Senate Finance Committee, I forget the name of it. She basically said, we, our little supermajority, we decide who gets a bailout, and sorry, small rural banks, you're not good enough to get a bailout. You're not big enough. We have to determine that you present a systemic risk, i.e., do you donate to our party, or, are you connected enough in Washington? And when I say party, by the way, folks, you Republicans out there, I'm seeing a lot of partisan comments, and you can probably figure out where I lie on the spectrum. Don't for a second think the Republicans are not part of this. Not for a second, folks. Maybe there's a few Republicans who are speaking out a little bit, but I don't hear much of anything but crickets from the powers that be in the Republican Party about this. So this is not a Democrat thing. This is not a left-right thing, folks. This is a they, us thing. And I talk about they all the time on this channel. They being the ruling class, the elites of this world. At the very top of the they pyramid are the bankers. And right now they're taking over the world. They are taking over everything. And let me explain how they're taking it over. This bank run is right now being limited to small banks. When they came in and they said, we are going to throw out Dodd-Frank, we are going to get rid of all the laws that we passed after the GFC to reassure the public that we had this. Apparently they didn't. We're going to throw that out, and we're just going to backstop Silicon Valley Bank over the FDIC limit of $250,000, which is great. I had just spent all this time doing this video on bail-ins. I actually put a ton of research into how bail-ins worked and what the Dodd-Frank law said and the intricacies of the ownership categories and everything. No. Silly Jack, silly rabbit. Nope, throw that out. And they just bailed in Silicon Valley Bank. So what they told was wealthy clients in any of the small regional banks, if you've got more than $250,000 in your account, leave that small bank, go to the big banks, and we'll give you free insurance that you can't get at the small bank. So the government response, understand this, folks, this is, and I've been pounding the table on this for the last 24 hours. The government's response to the bank run now is the bank run, okay? This run on small regional banks that's going on right now is being driven by Janet Yellen and Jerome Powell and whoever, Muhlenberg, whatever his name is over at the FDIC. That is what's driving this run on the small banks right now. Go to the big banks where you get free insurance, or stay at the small banks where you're at risk if you're over 250,000, and we can't help you if that bank fails. And so all the big money is fleeing the little banks. So if the FDIC does not come out fast, and I mean fast, they need to come out and they say, sorry, folks, we screwed the pooch on this one. By the way, you and I, we're the pooch. Sorry, folks, we screwed the pooch on this one, and we're not going to guarantee the deposits over $250,000 at Silicon Valley Bank. If they don't do that, within a matter of, weeks, months, years, every small and regional bank in the United States will be gone. They just won't survive. All the money will flood into the big banks. Now, let's say instead of doing that, instead of saying, sorry, we screwed the pooch, you're the pooch, I'm the pooch, sorry, we screwed everybody, instead we're going to backstop all deposits in the United States over 250,000. Well, if they do that, they're going to create an international bank run where all the money in Asian banks and all the money in European banks over in short amounts will come flooding into the United States, where the FDIC will end up insuring all the money in the world. So if they don't come out and walk this back soon, they're either going to wipe out all the small regional banks in America, or worse, they will create an international bank run. And I don't think I'm being too hyperbolic here. And we're already seeing stories right now that the bailouts that were announced, the rescue packages that were announced, are not enough. The flight from Credit Suisse is continuing. The flight from First Republic is continuing. And these $50 billion amounts for Credit Suisse, the $30 billion amount for First Republic, they're going to burn through that real fast, and we'll be right back where we started. So they need, our regulators right now are, I don't know if they're asleep at the wheel. I don't know how you would describe them. I'm a little tired here, folks. I've been running nonstop all week, so my metaphors are coming up short right now. They're screwing up royally. Anyways, let's bring in my man, my moderator, Mish, and let's take a quick walk through some of the stocks and the indexes right now and see what's going on. Mish, how we doing today, brother?
You're right. It's been a crazy week, man. You can start seeing it on people's eyes. Like Joe's looking tired, man.
Joe Brown?
Yeah.
Yeah, I really wanted to pick Joe's brain, especially when I saw some of the details of the FDIC package and, the bank term funding program. I really wanted to get inside Joe's head on that issue, because Joe, he's one of the best out there, folks. When we say Joe, we're talking about Joe Brown over at Heresy Financial. He's fantastic. He is really sharp. I learned so much watching him. And I shot him a text. I'm like, hey, Joe, any chance I can interest you in an interview? I know you're busy because everybody's running ragged. And he says, I can do it right now. So I was like, drop what I'm doing. Actually, I was on the phone with you.
Talking to me.
Yep. Yeah, and I was like, sorry, Mish, got to go. Joe Brown says he can do an interview right now. So I dropped what I was doing. I brought Joe on the channel, and we had a talk. And you could see, he was saying the same thing. Like, he was just so exhausted from everything and the rate at which the news was coming in. And he was, we're doing our best to keep up with it, but the stories are flowing really fast. By the time you can get a video produced, edited, uploaded, and done, it's almost like it's old news. It's really hard to stay on top of this. And he was mentioning that it was wearing on him. And the other thing is, it's really hard to you have to not get excited. Like, right, we're Perma Bear, right? It's right here. It's written on the sleeve. And I've been talking about this, maybe not this exact scenario, but a very similar scenario since I started this channel. And there is a tendency to want to dunk on people with this. There is a tendency to want to take a victory lap. And you have to remember, you're talking about people's lives getting destroyed right now. So you have to contain your enthusiasm, even though everything inside you is screaming, it's finally happening. It's finally happening. And I understand now that scene in The Big Short with Ben Rickert, Brad, what's his name's character? Jeez, I can't even remember the guy's name. Brad Pitt's character, when he was saying, just don't freaking dance. Just don't dance. Like what that means. I get it now. I kind of feel that. But all right, let's see what's going on in markets. And by the way, Mish, you have done a fantastic job this week staying on top of the stories, the number of text messages, the number of Twitter DMs, the stories that you have caught as they break in. Fantastic job, sir. Job well done.
I do need to thank Discord at this point, because some of those do come from Discord. My nose is in a lot of news organizations, and Discord helps cut down on that, to be honest with you.
Yep. And thank you, by the way, to all the folks on Discord who are acting as this intelligence network for the channel to keep the information up to date and flowing. You guys do an awesome service for the channel. Thank you. All right, let's see what we got going on in stocks right now. The S&P down 40 points, or 1% on the day. It's actually not that bad a day considering the bank run going on. Just want to look at the S&P chart right now. Here's Jim Cramer saying, I repeat, this is a bull market. A couple days back, that was back at the end of February when Powell was talking. Or I'm sorry, the beginning of February. And look, just zooming out a little bit, folks, here's this downward trend, the bear market of 2022, right? And we broke out above that. And, I was saying we were probably going to retest that line. Well, isn't that exactly what happened? We came down and we retested that line, and we bounced right back above it with the rescue plan that was announced on Sunday. So as of right now, first retest has passed, we are still above this bear market trend. We'll see if it holds right now. The market right now expressing a lack of confidence in the bailout package. Looking over at the Dow, down 380 right now, or 1.18%. The Dow was down 450 points earlier. Again, all things considering, not too bad for the Dow. Dow right now, not really seeing a whole heck of a lot, although we did give up both the 50-day and 200-day moving average over these last few days. So Dow's not faring so well, but all things considered, could be a heck of a lot worse. The Dow was actually positive for the week for a little while there. And looking at the NASDAQ, just, off to the races with the NASDAQ. Although right now it's down 76 points, 0.67%. The NASDAQ should be down, but it should be down a lot more. Currently at 11,638. And looking at the NASDAQ, we actually got a golden cross in the NASDAQ this week. 50-day moving average moving above the 200. Go ahead, Mish.
Nuts. That is nuts.
Can you believe that? Golden cross, if you're not familiar, golden cross is when the 50-day moving average crosses above the 200, and that is one of the most bullish technical signals you can get. And NASDAQ just put that one in 2 days ago, and then yesterday, almost 300 points up on the NASDAQ. Well, it's real easy for the NASDAQ to rally when every time things get difficult for tech stocks, regulators change the rules, inflate away your value, your savings, and prop up the value of these cash-burning companies. It's nice when the rules always change every time you start to lose. I got to get me some of them. Changing rules, man. That's what I got to do. I got a couple of folks here in the Super Chats already this morning. Thank you, guys. This morning. It's not the morning. It's the afternoon. The days are just blurring together, guys. Let's see. Where are you? I'm going to find you. Come. Nashville Pasta Man is in the house. What's going on, Nashville? He says, to quote Derek Zoolander, great movie, if you see a thread, pull it. Or Mugatu. What am I, taking crazy pills?
Mugatu, man. Will Ferrell was so great in that.
He was really good.
He's so hot.
And taking crazy pills. When you feel like you're the only sane one in a room full of crazy people, you have to stop and ask yourself, am I the crazy one? And thank God for you guys, you melon heads, because I have been staring at the charts in disbelief, watching high-risk tech stocks fly high this week on this liquidity bazooka. I mean, it makes sense why they're flying high, because they're turning the easy money on. But cash-burning companies, we are on the brink of the mother of all recessions. I'm going to show you the oil chart in a minute and what that's calling out. And I'm just sitting here saying, am I the crazy one? I have to wonder, am I the crazy one? Thanks to Nashville Pasta Man, I don't feel like I'm taking crazy pills here. But thank you very much, Nashville Pasta Man. Appreciate the super chat. Support the channel, sir. And AK is back. AK says, gold is money, everything else is credit, according to Mr. J.P. Morgan in 1912. That is an accurate quote. I agree. Gold is money. Maybe not everything else is credit. Silver's money, too. And I know I might ruffle a few feathers. I think Bitcoin is money also. But everything else is credit. And by the way, we're seeing gold, silver, and Bitcoin rally right now, and I don't think that's an accident. All right. Maybe Bitcoin is a little surprising, but when you look at the NASDAQ and you see Bitcoin running, okay, it's a little bit of risk on, dollar debasement. Makes sense that Bitcoin would run in that scenario. Although I've got a lot of messages from people asking about Bitcoin. I'm a little bit skeptical of the Bitcoin rally. I do think it should be running, just not as hard as it's running right now. I think there's some shady characters in the crypto space that are trying to engineer a FOMO rally in crypto right now in order to get some exit liquidity for themselves so they can get out before their exchanges blow up or before their DeFi platforms blow up. I do still think there's some rot yet to be carved out in the crypto space. That being said, regulators are giving us a choice right now. Head over to the big banks and join in their World Economic Forum, woke, whatever that's going on at the big banks. Risk the social credit scores or the CBDCs that they're going to come out with pretty soon. I mean, FedNow just announced this week. It's coming in July, FedNow. Or you can unbank yourself. And to my knowledge, there's 3 good ways to unbank yourself: gold, silver, and Bitcoin. Those are the ways to unbank yourself. There's there's other speculative cryptos, and there's other more speculative metals like platinum and palladium. I get those. Those have other concerns and other market factors, and they're a little more volatile. But really, gold, silver, Bitcoin, those are the 3 big ones. And that's what we're seeing. We're seeing people unbank themselves. And I'll be honest with you, watching Janet Yellen speak yesterday, my God, that clip made my skin crawl. And I was like on the brink of a coma last night. By the time I went to bed, I was ready to just drop. And I'm telling you, the burnout is real. And when I saw that yelling clip, I almost like just got out of bed that minute and started recording the reaction video. And I convinced myself, I said, nope, I have a window between the two live streams on Friday. I can get that video done. So I made myself go to sleep last night. It was hard to switch my brain off because my blood was boiling when I saw that. It really was. Go check out that Janet Yellen video I did, by the way. After the stream is over, folks, you have to see that video. I just released it a few hours ago, and I need you not just to watch it, I need you to share it, and I need you to talk about it. And look, don't get me wrong, I don't mind the engagement, right? This is my business, and I get it. I want it to run, right? But I don't always ask you guys to share it and to push it out and to talk about it. This one, I will. I reserve that for when it really matters. People need to know what is going on with this big power grab at the banks. They must understand that. It's not too late to stop it. It hasn't completely happened yet, but there is a very short window to stop this takeover of the big banks. Once the big banks have all the money, there will be no stopping them. They will own everything and thus everyone. They'll own all the politicians. So please, that video I did, the response to the Janet Yellen clip with her and I can't remember the name of the senator from Oklahoma, you must go out and see that one, folks. It is very, very important.
Actually, I like the Thomas Jefferson discussion. He was very anti-bank and he was very anti-government bank. He says that, basically the day you turn your life over to the banks is the day you end.
1913 was the day it was all set in motion.
Mm-hmm.
This little republic of ours, we made it a few years without going down the central bank route. But even after his death, eventually Mr. Hamilton got his way and the central bank was created in the middle of the night. Creature from Jekyll Island is on my reading list, by the way. Well, it's not yet on my reading list because I haven't read it. It's on my list of things to read. Currently reading Fourth Turning. And I have got Cheese Dip Marin. Hello, Cheese Dip Marin. That's a good name and a new one. Welcome, Cheese Dip Marin, and thank you for the super chat and the support of the channel. How safe are credit unions at this moment? Since they announced big banks will be insured and people are rushing to big banks. Okay, so this is a tricky one, Cheese Dip, because I have to choose my words carefully here. All right, it has occurred to me that what is going on is a psychological reaction. There is a panic happening in financial markets. I don't want to add to a panic. At the same time, I want to be as accurate as possible in my commentary. I don't want to self-censor. I want to call it how I see it. All right, so I'm not about to go yank my deposits from a credit union because my accounts are all smaller than the threshold, than the FDIC threshold. So if you've got $20,000 in a checking account or $50,000 in a savings account or even just a few $100s in account at a credit union, you're okay. You're safe because you are FDIC insured. What's going on with the bank run and with the situation with the regulators they've created only applies if you're over the FDIC insurance threshold, over that $250,000 threshold, which most of the customers of Silicon Valley Bank were over that $250,000 threshold. Now, if you're over that threshold, then you're exposed to that bank failing. And what's happening right now, because the FDIC and the Department of the Treasury and the Federal Reserve has come out and said, free insurance over at the big bank, all the big money is leaving the little credit unions. All the, if a business with $1 million in their operating account, they're moving over to the big banks because they get insurance for nothing there. And so the big money is running. The small money, right, the personal accounts, that money is safe at the credit union. Even if the credit union fails, the FDIC pays you. You get your money back, and probably in relatively short order, too. The only question is, if you are a big customer, if your business account, if you've got $400,000 in a checking account at a credit union, I don't know why anybody would have that kind of money in a checking account, but let's say you did, then you are potentially at risk. And understand, even if you're not moving your $400,000 out of that credit union over to the big bank, everybody else at the credit union could be doing that. Now we're like in the game theory. Well, if everybody else might do it, I better do it first. And now it kind of takes on a life of its own, and it just happens. So it's kind of, if you're over that high threshold, over that FDIC limit, the government has created conditions where you almost have to move your money over to the big banks. I don't think that's an accident. I'm not sure if it was willful deceit ignorance, accident, I don't know. But regardless of why, the net effect is they're creating a monopoly for big banks. It's being created right now, and the FDIC must come out and walk back this over $250,000 insurance. They must get rid of that. If they don't, and the clock is ticking on that, if they don't reverse this policy, they will destroy all the small banks in the country. And if they extend the policy to all the small banks, which they're going to be pressured to do, then they're going to destroy every bank outside the United States. Because the same thing will happen. Foreign investors will flee their banks where it's not insured, and they'll come here. So the FDIC is on the clock here. They need to reverse this policy before they destroy the banking system as we know it. And look, I am not necessarily a big fan of the banking system as we know it. Don't get me wrong here. If you've been watching this channel for any amount of time, you know that. That being said, what they're doing right now is so just unethical, unreasonable, dangerous, reckless. Like, what the hell do they think they're doing? I don't know. But they need to reverse it. They're making it worse. And that's why the regional banks are still getting slaughtered today, despite the rescue of First Republic. It doesn't matter. They've created conditions where that money will naturally flow out of those regional banks. So I hope I answered your question, Cheese Dip Marin. And, I was parsing my words very carefully there because, I don't want to be accused of fudding and everything, which, I get it. I get that all the time. I'm not really known for my optimism, so sue me. But I'm trying to at least stay somewhat factual here, even though my blood is boiling with rage on the inside. I'm doing my best here, folks. Thank you very much, Cheese Dip Marin. I appreciate the super chat. And very good question, by the way. Steve Voitis is in the house, says, bank instabilities aside, we still haven't felt the full lag effects in housing and credit markets due to the rapid rise in interest rates. My God, Steve, I know. And folks, if you don't know what Steve is talking about, like, this bank run that we're seeing right now has nothing to do with the housing bubble. It has nothing to do with the consumer credit bubble. Nothing to do with commercial mortgage-backed securities. Nothing to do with the auto loans that are going default. Those are all tomorrow's crises. Crises. Plural. Plurality of crises. Many crises everywhere. Those haven't even started yet. This is just everybody suddenly realized how much money the banks lost on bonds in 2022 because of the Fed's rate hikes. That's what this bank run is. This is like the side effect crisis. This is like the pregame, right? This is like, T-shirt time, the shirt before the shirt.
Yeah. So yeah, I think I was talking about this in Discord, how we're still in the warm up. We haven't actually started the game yet. So the big rate increases didn't start until last summer. And since most of our debt in companies too, not just the government, is a year or less in duration. So they're not going to start feeling these interest rates till this summer. So we haven't even got to that yet.
That's a good point. So the lagging indicator
nightmare is not even gone through the system.
Folks, we're just looking at 1 year since the first 25 basis point rate hike. And I'm not sure it's really like a cutoff of exactly 1 year, but Mish, you're right. You're at least in the ballpark. We're just beginning to see the effects of the initial rate hikes. And the rate hikes didn't really hit their stride until the end of the summer when the 75 bippers started, right? Mm-hmm. That's when the big rate hikes started hitting. We haven't even begun to felt that yet. Oh, man. Wow. Sometimes maybe even I am too optimistic, if you can imagine such a scenario.
Well, let's talk about that. The 10-year. I asked Jack about this old chart we used to have about a year ago. We used to chart when it came up, right? So I said, go look at that chart and see if we're going to come back and retest. And he's like, well, they're not there yet. I said, we might be there by this time next week.
Yeah. You guys remember the chart? I mean, if you've been on the channel for a while, I was talking about how 2.2% was when they were going to break something on the 10-year. And we crossed 2.2% a long time ago. So obviously that was not the right call. Although you could argue they did break something right around that time and we're just now finding out. Yep. But that's neither here nor there. It didn't happen at 2.2%. And so this is that declining trend line of all the big financial crises of the last 40 years or so. And they all happen on this descending trend line. And we crossed that early last year, right about March, April timeframe. And what Mish is saying is, hey, we're about to go back test this line. And my initial reaction was, no, we're a long way off. And then I remembered the 50 basis point rate hike conversation where I should have learned my lesson not to reflexively dismiss when Mish suggests something. And then I went and I looked and I was like, son of a gun, you might be right. I mean, you see this red candle here? We get a couple more of those, we'll be right back on this trend line. And if this collapse gains steam, big if, but if, we'll be there real fast. Remember how fast the rates dropped in March of 2020? I mean, we could be there in a day or two. So don't think it couldn't happen when we could come down and back test this line. Absolutely.
We're doing 20, 30 point moves a day right now. We could be to that line.
I mean, let's talk about that right now. I mean, while we're on the bond topic, look at the bonds today. 10-year Treasury down 19 basis points, 5.3% at 3.39. I mean, we were over 4. What, a week ago? We were over 4. 60 basis points in 5 trading days. Good God. And then look at the big move today. The 2-year, 31.5 basis points on the 2-year, down 7.6% at 3.81. These kind of moves are not supposed to happen in U.S. Treasuries, the most liquid assets in the world. All right.
Also something else to think about is the Fed rate is 4.5 to 4.75. The entire curve has detached from that.
Yep. Yeah. Look, I mean, the overnight rate at the Fed is 4.5 to 4.75, and yet the 1 month is 3.9. Okay. 1 month is saying rate cuts coming real fast, isn't it?
Yeah. They're saying they're starting to say that the Fed has made a mistake. Is what, if you read the bond market, that's what the bond market is currently saying.
Yeah, I mean, the Fed has made a mistake. Understatements for 1,000, Alex. Yeah, you could say they made a mistake. I want to say thank you to Michael Williamson for the super sticker. Mike, the super stickers don't always come across on the StreamYard platform, but I got to scroll way down. I can't even see it on the iPad feed. The chat is scrolling too fast. But thank you very much, Mr. Williamson. I do appreciate the super chat, sir, the super sticker, and the support of the channel. Guys, appreciate the generosity. Thank you very much. And Cormac Kilroy. What's going on, Cormac? It's good to see you. He says, happy St. Patrick's Day, guys. I didn't even know it was St. Patrick's Day.
Mm-hmm.
Wow. Okay, it's St. Patrick's Day. Well, I didn't need an excuse to crack one tonight, but now I have it. So thank you very much, Cormac. I appreciate that. He says, happy St. Patrick's Day, guys, from here in Ireland. Jack Mish, please go have a pint of Guinness. You work too hard, guys. Cormac, I think we're going to need something a little bit stronger than a pint of Guinness tonight, if you don't mind. I think
a little bit of Ribena, a little bit of whiskey topped off with a pint doesn't sound too bad.
Yeah, it's a good night for a me and Coke. That's what it is. That's every time I have a Jack Daniels with a little bit of Coke in it, I call it a me and Coke. That's my winter drink. It's a me and Coke in the winter. It's a Victor Tango in the summertime. I have my winter drink. I have my summer drink. So that's kind of how I roll anyway. But thank you very much, Cormac. Had trouble getting that one out. My vocal cords are getting a little sore after this week. We've been doing a lot of lives. Cormac, you are a gentleman and a scholar, sir. And happy St. Patrick's Day to you from the other side of the Atlantic. Enjoy, sir. And we got Cheeseburger. What's up, Matt? How you doing? He says, do you remember when you used to sign off by saying, the hard times haven't arrived yet. So make the most of the time you have. I guess time is up. Nope, time's not up just yet, Cheeseburger. Not just yet. They're coming. They're closer. They're sure as heck are a lot closer than they were. But you know what? Use your cab driver indicators. And guys, this is a little social thing for the weekend, right? When you're gonna leave your immediate financial circles, you're gonna leave your immediate, talking points and everything with your coworkers, the people you talk about this stuff with, and you're gonna go hang out with friends who don't live in this space. Before you tell them what's going on, and I do want you to tell them what's going on, gauge where they're at. See what they're talking about. And I'm willing to bet most of them are not talking about banks. Even though they don't realize it, it's the most important thing going on in their life right now, outside of how well the wife and kids are doing and their health and everything else. But this is probably the single most important issue in 99% of the population's life right now. And I'm willing to bet a plurality, if not a majority of them, does not even know it. They don't even know about it. They heard a thing, yeah, but they don't have time for that. It doesn't affect me. So explain to them how this affects them. Explain what's going on. Hey, if you want to reference my channel, I'd sure not stand in your way of doing that. But I do usually say, yeah, folks, hard times are coming, but they're not here yet. So make the most of these good times while you have them. And I do still think, believe it or not, I do still think these are the good times. And that is not me being optimistic. That is not. I do think there will come a day in the probably not too distant future where we might look back at this very day and wish we still had it so good. So, you know,
I
always
do want to
remember to smell those
caution,
roses, guys. Go ahead, Mish.
yeah, I do want to caution people, and I know we're starting to back up on super chats, but um, if the melt happens, do not try and beat it. If you miss the takeoff, you've missed it. Wait until it slows down, because if not, you're going to FOMO in and lose money.
Yeah. Like let's say this time Friday, right? A few minutes before close, you saw what was happening and you FOMO'd into a NASDAQ short, right? Which on Friday would have looked like a sure thing. That would have looked like the best bet in the world, right? You would have been like, whew, I just made it. Only to have the Fed come in and smash your put on Sunday with their bailout package. And look what the NASDAQ has done since that happened. So be careful, guys. I mean, the regulators right now, they are just throwing mud at the wall. I have to say mud because I don't want to get censored, but they're just throwing it against the wall to see what sticks. It's freaking amateur hour in the regulatory department right now. They have no idea the havoc they're causing, or even worse, they know exactly the havoc they're causing and they're doing it anyway. Pick your poison there, whichever one. Don't try to chase this. Don't try to beat it. I mean, they're making up the rules as they go. It is not a level playing field. And you know, if you're one of those guys who went short the Nasdaq on Friday, it was a good bet, and then they went and changed the rules. You could have said, no, they're not allowed to bail out the bank. Silicon Valley is going to lose all of its money because Dodd-Frank says they have to. And that would have been the right call. And yet here we are a week later, screwed, totally hosed trade because they just changed the rules. They just threw them out. So you have to recognize that it is not a fair playing field. They can change the rules to suit them at any minute now. That's why the first rule is never fight the Fed. Never fight the Fed because they literally have it own a money printer and they can make up the rules as they go. So it's really hard to trade in this environment. Be careful. Don't go out on margin. Don't go out on leverage. They will wipe you out. Okay. And again, I can't tell you what to do with your money. I'm not allowed to. I don't have that piece of paper from the government that says Jack is allowed to tell you what to do. I can tell you what I do with mine. I don't touch leverage or margin in this environment. I just don't. It's too freaking dangerous, guys. Not when they can just change the rules to suit their trades. Thanks again, Cheeseburger. And thank you, Mike Bender from Robin RC Models. Says, in my opinion, biggest accident to happen are corporate bonds. Yeah, well, let's talk about corporate bonds for a minute. I mean, the Fed is backstopping the bond losses from treasuries and the bond losses from mortgage-backed securities. But, you know, what about Jabroni Company that borrowed a few $1 billion in the bond market and they issued some junk bonds against those? Is the Fed going to end up backstopping all of that crap? Is all of that garbage going to end up on the Fed's balance sheet? Because if they don't, if we get a blow up in the junk bond market, that could wreak havoc across other asset classes. That could drive companies bankrupt. Is the Fed going to come in and backstop all those losses? How much of that junk is sitting on the balance sheets of whatever? Mike, it could be corporate bonds, Mike. It could be commercial mortgage-backed securities. It could be these ABS, these auto loan bonds that are car loans are being packed up into bonds and sold. And, you know, we're already seeing some of those outfits are starting to go bad. American Car Center just filed for bankruptcy after trying to unload those garbage car loans, these $1,000 a month payments from somebody who doesn't even have a job anymore. They tried to securitize that debt and sell it off. That didn't work, and they went bankrupt. So pick your poison, and that's another point. In 1 second, Mitch, I'll give it to you. That's just another point about, like, this is not the unraveling. This is not the debt crisis. I mean, what Mike just mentioned here, the corporate bonds, that's one of many things that could blow up, causing the next debt crisis. We're not even there yet. Go ahead, Mish.
Well, the earlier comment about the credit unions, the only issue I have is that they are primarily car notes. When you go get a car loan, you go to a credit union. And that's why so many credit unions have failed over time, is because of that. Once people stop paying their cars, they've got risky loans, boom, they're done. So we're starting to see that underwriting in the car market by there's now two companies have said we're pulling back our bonds.
Yeah. And
So
again, I
that's
just want to add the
holding
rider.
question.
I
Yeah.
just want to add the rider about the small accounts at the credit union. There is no reason to go run and panic withdrawal from
Mhm.
a small account at a credit union. All right. If you're below the FDIC limit, you are guaranteed you are safe, period, hard stop. All right. So please, before we get accused of adding to a bank
Yeah,
run
no, I
here,
got it. Yeah, yeah,
you
yeah.
know, but it's the big money that is running the safety right now. The big money that is not insured. They're the ones leaving. Okay. You guys, if you've got a couple grand or a couple hundred in an account at a credit union, you're safe. You're covered by the FDIC. Thanks again, Mike. Appreciate the super chat, sir, and the support of the channel. Scrolling down, we got Kevin DeBella. Hello, Kevin. Thank you, sir. He says, I think the bond market is making more mistakes than even the Fed. Bond market will implode before the Fed is done screwing us, and then major crisis. I'm wondering what you mean by a bond market implosion, to be honest with you. Does that mean like a sudden spike, blowout in borrowing costs, like basically liquidity drying up? Yeah,
Yeah, I
we
think
could
that's where
see
he's going
that.
with that.
And I think we probably came really close to that this week, but the Fed stopped it before it started. The Fed fired off their liquidity bazooka. I mean, they look at the Fed's balance sheet real quick. And look, I know there's some heated discussion going on FinTwit about is this or is this not inflationary. Um, Look, the Nasdaq, Bitcoin, gold, silver, all saying it's inflationary. So for now, I'm going to go with what the data says, and semantics be damned. This is inflationary. Look at this spike up in the Federal Reserve's balance sheet. I mean, this is all the quantitative tightening going back to the beginning of QT, right? Back to last March. It actually hit the books in April when we were at 8.9 trillion on the balance sheet. And this is all those months of rate hikes in QT. And look at how much in 1 week, $297 billion parked on the Fed's balance sheet. They undid almost half of all the QT of 2022 in a week. And it's just the first week of this crisis. Who knows what this is going to look like by the end of next week?
We also
So,
saw M2 crash. So we have two different issues going on right now. We have M1, which is the Fed, going straight up. M2, which is the debt, is going straight down. So what that tells me is people are getting money to pay off debt.
and here is M2 money supply. And by by crash, there you go, Mish. There's this little bitty decline there in M2 money supply. That's it right there.
But that's a week late.
Yeah, you're right. It's a week late. Now, here's the thing. It's actually, this is only up to January. Just the money supply not expanding anymore is enough to cause something like this, because in a fiat debt-based system, you need more and more and more debt. And let me go all the way back to 2000, right? Like, look over here. Just this, it never goes down. It never drops. It doesn't. A tiny, even if it just flattens out, we get a big crisis. It needs to perpetually rise. They need more debt. They need more money, always,
So
forever.
even
Or
that
this happens.
small decrease is huge economically.
Yep. Let me see if I can get back to where we were in 2018. Even there, when we started QT, when did we do QT last time? Was it like 2017 that they started quantitative tightening?
They didn't do it in 2019?
They stopped at the end of, was it at the end of 2019?
Mm-hmm.
Either way, it doesn't even register here. The money supply was growing all throughout the last time they did QT because we had credit expansion. So, and even that, just a slowing in the pace of the money supply expanding is enough to cause this. It's a fundamentally flawed system. So, will the bond market implode? I think the bond market is probably less likely to implode, at least in the short and the medium term right now, because the Fed has bazookaed liquidity again. And I don't think they're going to stop doing that. I think they've made it perfectly clear, and they arrived at this decision shockingly fast. You know, I used to say, when is the Fed going to turn the money printers back on? And I would always say, because we begged them to, is why they're going to do it. We didn't even get a chance to beg, did we? They just did it. The second it got a little frothy, they turned it back on. So, you know, when they're dumping liquidity into the system through the discount window, through this BTFP or whatever, through whatever process they're doing it, they're increasing liquidity. It's tough to have a blow up in the bond market when they're doing that. So I think we probably got our answer, in the short term, that we're probably not going to see that blow up, at least right now. Thank you very much, Kevin DeBella. Appreciate the super chat, sir. And are we backed up? Are we caught up yet? No, we're not. Dan Hadeen, what's going on, Dan? Remember, buy silver and platinum. Dan likes silver, and Dan likes little silver. Little silver is the platinum. I like both of those. I like silver. Let me just caution you on platinum a little bit. There's two big narratives with platinum, and maybe caution isn't the word. Just things to consider with platinum. All right, you have got the bullish case of limited supply over at the COMEX, and the bullish case of uncertainty with the power grid in South Africa. 80% of the platinum in the world comes from South Africa, and if you get widespread grid failures in South Africa, which we're already starting to see there, it's going to get harder and harder for them to get the platinum out of the ground, so we see global supply contract, sending prices higher. That's the bull case. The bear case, nobody can afford a car. And the main use of platinum is still catalytic converters. All right, so if nobody can afford a car, then nobody needs a catalytic converter, and so the demand for platinum is going to be affected. And I think that's the only reason platinum prices have not exploded higher on the South African news is uncertainty with automotive demand. Mish, you look like you're chomping at the bit, like you want to weigh in on this one. Did you have something you wanted to say about platinum?
No, well, we're talking about something else in chat, but we're talking about the currency swaps. So there's this huge amount of currency swaps, and that's actually how the Fed bailed out Credit Suisse in December. They did a credit swap over to the Swiss National Bank, and it wasn't recorded anywhere because it's a currency swap. So they've done all these currency swaps to the order of 80 trillion-ish. And no one really knows the outcome if this had to unravel.
Because it's all off the balance sheet.
Mm-hmm.
What was the IMF did that report? It was really scary in its headline. I can't remember how it went, but it was something like unreported, untraceable, and massive. I can't for the life of me remember the title of that report, but yeah, the numbers were ungodly size numbers, like $80 trillion worth of these currency swaps that are out there, and they're not tracked on anybody's balance sheet. So they're all off balance sheet. It's secret debt, and I'm sure they are using those right now, especially with Credit Suisse blowing up. And thanks again, Dan Hadeen, by the way, for the super chat. And speaking of Credit Suisse, let's talk about this story because we haven't gotten to this one yet. Some Credit Suisse counterparties put curbs on new dealings involving the lender. This came out in Reuters just a few hours ago. All right. And this just goes to show that even that $50 billion bailout of Credit Suisse from the Swiss National Bank, which I'm sure was involving some currency swaps with the Federal Reserve, even that may not be enough. Probably is not enough. Let me just read a little bit about what's going on here. At least 4 major banks, including Societe Generale and Deutsche Bank, have put restrictions on their trades involving Credit Suisse Group or its securities, according to 5 sources with direct knowledge of the matter. There's those arbitrary, unnamed sources again. Credit Suisse declined to comment. The bank had previously said it was strong. Well, of course they did. And I just want to get a little bit into some of the details of what these banks have done. Societe Generale has maintained existing counterparty positions with Credit Suisse, which had cut back in recent weeks, but it is not increasing them. Basically, they're not taking any more trades with Credit Suisse, where if Credit Suisse defaults, they would lose money. That's according to 2 people over at Societe Generale. They declined to comment. Deutsche Bank, meanwhile, this week has slashed the lending value it assigned to Credit Suisse securities, such as bonds put up by its wealth management clients for collateral for loans. That's according to a top executive at a European wealth manager that has business ties with the German lender. Earlier, the bank would value them at 70 to 80% of face value. So Deutsche Bank will not loan money anymore, or Deutsche Bank will still loan money against Credit Suisse, but they will not let you borrow face value against Credit Suisse debt. They used to lend you between 70 to 80 cents on the dollar for Credit Suisse collateral. Now it's even lower. So Deutsche Bank is pulling back on how much counterparty risk it will accept from Credit Suisse. HSBC, private banking business, has also started scrutinizing its loans linked to Credit Suisse security, which are in the hands of clients in Europe and Asia. According to a source with direct knowledge of the matter, of course, everybody's anonymous. The source added that the bank has not taken any decision yet on lowering its exposure to the Swiss lender, but was watching developments closely and will take a decision on this early next week. So HSBC going on defense, not looking to get into bed with Credit Suisse. Now we've got an anonymous source at an anonymous bank on this other story. Another source at a major global bank who deals directly with Credit Suisse in Asia said their bank had started asking the Swiss lender to gross settle a trading scenario where the counterparty demands upfront payment from Credit Suisse instead of collecting later any money the Swiss lender might owe them as a result of a trade. So this random bank with an unknown spokesperson somewhere in Asia is saying, Credit Suisse, you want to do business with us? Cash up front, no credit, no IOUs, sorry. Yet another global bank has reduced its unsecured exposure to Credit Suisse, which includes all lending with no collateral, according to a person with knowledge of the matter. The bank is still providing repurchase agreements, which is secured lending. So all of these banks are starting to squeeze the cheeks, if you will. They are not willing to add any counterparty risk involving Credit Suisse. Now, are these the actions of people who believe that Credit Suisse is safe? Are these the actions of people who believe in the resiliency of the banking system, as all of these regulators and central bankers are out there telling us in the press right now? Do these sound like confident people to you? Not even close. So this is why I said in the thumbnail, not enough. This $50 billion that they gave Credit Suisse, they're going to blow through it like that. If the big banks are not willing to accept their debt as collateral, they're not willing to accept any kind of IOUs, they want cash up front in order to take any positions out, then I guarantee you the powerful people are still pulling their cash out of Credit Suisse. If the big banks aren't convinced, then the big bank customers are not convinced either. So I don't think Credit Suisse makes it. And by the way, the bond market says so too. This is in Bloomberg, dated yesterday. These Credit Suisse bonds signal the bank's $54 billion lifeline. That was 54 billion Swiss francs. It's about 50 billion. Or is it the other way? Or is it 50 billion Swiss francs, 54 billion? Whatever.
No,
Nuance.
it's $50 billion.
$50 billion lifeline, thank you, Mish, may not be enough. Bail-in bonds may be converted to equity if regulators step in. A category of Credit Suisse's bonds is warning that a liquidity lifeline from Switzerland's central bank may not be enough to stabilize the embattled lender. The bank's holding company has almost 76 billion Swiss francs, or about $82 billion, of bail-in bonds and additional tier 1 notes that are trading at distressed levels. If the regulator steps in to protect Credit Suisse depositors, the AT1s would be written off while the bail-inable senior holding company debt would be converted to equity. So these AT1 bonds are basically worthless if the bank goes under. They are not at all secured. And these things are trading at, what are they trading at on the dollar? I thought.
Well, while you look that up, you also have to remember that the Credit Suisse has been embattled for a very long time, and they were burnt. Well, okay, Silicon Valley burned through almost $20 billion a day, and they don't have the depositors like Credit Suisse does. So even at face value, if they're burning through 20 billion a day, they bought themselves 3 days.
Wow, 3 days. If they hadn't slowed, and even if they just slowed it, maybe it's 4 days, maybe it's 5 days.
Mm-hmm.
By the way, it is 66 cents on the dollar that those bonds are trading for. Those bonds are trading as if the company is about to go bankrupt any minute now. So that's the bond market saying Swiss National Bank, not enough. And that's not the only story going on right now. Check this one out. First Republic's $30 billion rescue fails to soothe investor fear. Despite deposit injection is a temporary solution, analysts say, and the engineer in me is saying there is no such thing as a temporary solution. Policymakers face tough choices if the rescue doesn't succeed. First Republic Bank staved off a potential collapse after a group of bigger financial firms agreed to park a combined $30 billion in deposits with the lender, but the cash injection is only a short-term solution, and investors are unsatisfied. The San Francisco-based company will still need to move quickly to find a way to remain independent or strike a deal for a takeover. What does that look like? Let's take a look at the stocks of these companies. First of all, First Republic. Oh, it's 404. Markets are closed. Down 33% on the day. And even third, look at that, 22.96. Gave up almost every penny of gains from that $30 billion rescue package. That is the market saying not enough. Credit Suisse, back under $2. Oh, I'm sorry, a penny above $2. Trading at $2.01. Down almost 7% today. That's despite a $50 billion rescue package from the Swiss National Bank. That is the market saying not enough. And, Credit Suisse, when was the package announced for Credit Suisse? Was that Tuesday?
The 50 billion? I think that was Wednesday.
That was Wednesday. So they were trading at about $1.90 when that was announced. They're up 11 cents. They're up about 5% on a $50 billion rescue package. That is the market saying not enough. So, it's like in the infomercial, when the first time the inventor gives his price and the infomercial host says, I'm sorry, J-Pal, you're going to have to do better than that. And the audience is all nodding disapprovingly. Oh, no, no, no. Okay, fine. 5 easy payments of $49.99, $99, $99, $95. They're going to have to pump more liquidity in if they want to maintain it. All right, guys, markets are closed. Let's see what we got. The S&P ended up closing down 44 on the day, or 1.12%. Not all that bad a showing, all things considered. The Dow closed down 384, or 1.19% at 31,862. And the NASDAQ rounded out the day at 86, down 86, 76 at 11,630, about 0.75%. Still monumentous week for the NASDAQ. Look at the NASDAQ. Opened the week about 11,131, now trading at 11,630. The NASDAQ is up 500 points a week after the biggest bank in Silicon Valley failed. Amazing. Amazing. It's clown world. Absolute clown show, folks. But don't fight the Fed. That is the rule. When the Fed opens up the floodgates of liquidity, get out of its way. Now, look, guys, we haven't even spoken about commodities yet. Look at commodities right now. Gold was up 58.50 today. 3% move in gold. Since when does gold move 3% in a day? That's a flight to safety, folks. That is people unbanking themselves. And good for you, whoever bought gold today. Don't take paper. Don't take paper gold. Put a pin in that. We'll talk about that in just a minute. Check out silver, up 92 cents. Almost got a full dollar today. 4.28% for my favorite of the shinies at 22.62. I keep hearing silver squeeze rumors, guys. They're buying up that physical. And wait till you see this nickel story. But first, crude oil WTI, $66.35, down $2, 2.93%. Natural gas down 15.7 cents at $2.35, another 6.25%. Look at oil right now, flashing the mother of all recession signals. Does that look like a strong economy to you? Oil does not do that in a strong economy, folks. No, sir. Nope. Now look at what we got here. We've got the liquidity floodgates have been opened. We've got Bitcoin running. We've got gold running, silver running, the NASDAQ running hot. At the same time, we have oil prices plummeting. We have terrible, terrible manufacturing news coming out every week. Another Fed PMI or another index coming out showing terrible manufacturing. We've got debt piling. Folks, it's April of 2020 all over again. Second things got bad, they opened the floodgates. And what followed April of 2020? We had a monster rally in stocks. I'm not saying this is what's going to happen. I talked about this on my morning show this morning. I'm not saying this is what's going to happen. But as of right now, the course that we're on, stocks will rocket higher on liquidity injection. Asset prices will balloon higher, followed by soul-crushing inflation. That's the order it hits. Right? First, they balloon asset prices. Then they hit consumer prices. And lastly, they hit wages. Right now, they're inflating the asset bubble. They're inflating risk assets, even though economic activity is slowing, just like in April of 2020, right? Stocks were going up in April. Asset prices were going up. Bitcoin was going up. Oil was in the toilet, and the whole world was shutting down. It's kind of what it looks like right now. The whole world may not be shutting down, at least not immediately, but look at all these manufacturing indexes and all these industrial reports. They're all showing declines in activity. Now, a second ago, I promised you nickel. Let's look at nickel. All right, price of nickel up $300 today, 1.3%. It's actually a pretty modest move for nickel, to be honest with you. But keep an eye on nickel. Check out this story. Uh-oh. London Metals Exchange, you have some splaining to do. LME finds some nickel underlying its contracts is missing. I'm shocked to read this story. Problem found at Access World Rotterdam warehouse, according to sources. Again, sources with no names. Gotta love it. Access World spokesperson declined to comment on nickel. By the way, in journalism school, don't they teach you to name your sources in journalism school? I didn't go to journalism school, but I'm sure they teach you to name your sources there. Everybody forgot that, but okay, moving on. The London Metal Exchange has discovered bags of stones instead of the nickel that underpinned a small handful of its contracts at a warehouse in Rotterdam, in a revelation that will deliver another blow to confidence in the embattled exchange. The amount of metal represents just 0.14% of live nickel inventories at the LME. They always seek to understate the scope of the problem. This is just what they found today, by the way. However, metal traders generally consider LME contracts to be beyond question. Not this guy. So the news that even a few of them could contain irregularities, that's a nice way of saying fake metal, is hugely problematic. The news comes weeks after trader Trafigura Group revealed that it had been the victim of a vast alleged fraud involving missing nickel cargoes that were full of rocks instead of metal.
That was from India to China, by the way. So now you've got China has problems at their warehouse. Every time they pop open a warehouse, who knows? India sent a ship full of rocks to China. Australia still don't understand about the doping, but I know what they did was dishonest at best.
Yep.
And now we have rocks in England in a warehouse. This isn't just China anymore.
Now look, folks, this is what's laughable about this. If they will do this to nickel, which I did the math, nickel is worth somewhere around 80 cents a troy ounce. Nobody measures nickel in troy ounces, but it's worth about 80 cents a troy ounce. And I say troy ounce on purpose. If they'll do this to nickel at the LME, what do you think they would do for gold that right now is pushing almost $2,000 per troy ounce? If they will stuff a bag full of rocks and pass it off as nickel for 80 cents an ounce, what do you think they'll do for $2,000 an ounce gold? And that's why I say, folks, don't touch that paper. If we're on the brink of the great unwinding, the great deleveraging, right? The big one that we've all talked about, right? That we know is coming someday. We don't know when. If you would have asked me a few years ago, I would have told you it probably happened already. But we know it's coming. And we know there is more paper claims on gold than there is metal. And if they're going to put stones in a bag and stamp nickel on it for 80 cents an ounce, you think they won't do it for $1,981 an ounce of gold? Be careful trading paper. Be careful trading metal on paper, folks. Because if that happens, if this were to blow wide open, if they were to find out that this silly nickel story is widespread, and that they're always so quick to remind you that, oh, it's just a small percentage, it's limited, it's a minuscule amount. They say that every time this happens. Well, if you take up the aggregate of all these minimal amounts that this keeps happening, it actually turns into a pretty significant amount. If that were to happen in gold, there would be a stampede for physical gold. And all the people who have sold paper claims on their gold will soon run out of gold to deliver and make good on those paper claims. And then it becomes possession is 9/10 of the law. Who's ever got it is rich. Whoever don't got it is hosed. That's why you got to pay attention to stories like this about a bag of rocks in a warehouse in Rotterdam and how that could lead to an explosion in the gold price someday. That's why I don't touch SLV. That's why I don't touch GLD. That's why I don't get involved in the futures markets. Maybe you can make more money if you're a skilled trader over there. I'm not that good at trading, so I don't even try, especially not, again, in the era where they just changed the rules. Remember, there was a nickel shortage, and they just shut down trading. Remember the LME nickel fiasco last year? And they didn't manage to clean out the warehouses? They didn't audit the warehouses after that? Wow. What were you going to say, Mish?
Well, they're getting sued pretty heavily because of that issue. So this issue is not done yet, and it has some backing of some pretty major parties. I do want to point out that it was in chat earlier, and I do not remember who said it, but the largest political party in Switzerland does not approve of the bailout.
You mean it hasn't been stamped yet? It's not. Right. It's not a thing yet.
No, they do not agree with it.
Wow. So, by the way, speaking of political parties in Europe, and I don't want to tread too far into political parties, but I have to send a shout out to all you folks in the Netherlands, especially all you farmers out there. I have not read the finer details of it, but my limited understanding is that the party representing the farmers in the Netherlands won a major victory yesterday. Congratulations to you guys. We are pulling for you guys. You are the front line in this war on our food production by the WEF and the globalists. And you guys won a battle on that front yesterday. So congratulations. Hold the line over there, you guys. Keep it up. Because they're going after our food. They're going after our energy. They're going after our money. They're going after us.
Yeah, Paris.
Hold the line, brothers.
Blew up again tonight.
What was that blew up again tonight?
Paris is blowing up again tonight.
Yep. Paris, the pension bailouts, which, look, it's writing on the wall that retirement age is going to have to go up at some point, right? When retirement first became a thing, the average person died before they retired. And now the average person lives a quarter of his life after he retires, maybe a half of his life after he retires. And so the math no longer lines up. That said, one politician unilaterally deciding, I will, after losing the vote, is not how you do that, especially not when you have made promises to people for their entire lives that you will take care of them in their old age. And then when that old age arrives, you say, oh, we're sorry. We have to bail out Silicon Valley instead. So I'm not saying Emmanuel Macron bailed out Silicon Valley, but there are ways to go about this, better ways to go about this. And playing with fire, man. They keep playing with fire. They got to be careful. You can only push people so hard. I want to send a thank you to the Inflation Situation, TIS. He says, you fellas are killing it, working hard this week. Grab a pint on me. All right, we're up to 2 pints deep now.
Yeah.
I'm gonna unwind the balance sheet of this week up here tonight. We're gonna grab a couple of pints.
I was telling Jack, I hope they give us 24 hours to kind of relax here.
No, I don't think they will. And folks, look, a lot can happen over a weekend, can it? Like, think about what happened last weekend. I had to go live both days last weekend because the stories were evolving that fast. And I'm hearing about more meetings. I'm hearing that the Treasury and the Fed are ordering U.S. banks right now to review exposure to Credit Suisse, which if Credit Suisse was bailed out. And remember Yellen talking about how they have such confidence yesterday in front of Congress and the banking system is strong. Why do they keep ordering everybody to review their exposure if they're so confident? I get not wanting to project weakness and not wanting to create a panic, but don't blatantly BS the masses either, right? You can reassure people, like, we have this thing like when I go to an accident scene and somebody's hurt, right? And there's a relative and they're all like screaming, oh my God, save him. Is he going to be okay? Is he going to make it? I don't lie to people and say he's going to be fine, especially not if he's messed up. You say we're doing everything we can for him. We're going to do everything we can for him. He's in good hands. That you could say. That's honest, and it's not false. It's not outright BS. For them to go on TV and say the banking system is strong, I have the utmost confidence in our financial institutions, and that's what you say in front of the camera, and then you're saying the exact opposite in the closed-door meetings, and we all know that's what they're doing right now. That's not how you restore confidence in the banking system, by lying to people. That makes people not believe you. That destroys confidence in the banking system. And right now, our financial regulators, our central bankers, and our bankers, our big bankers, are destroying confidence in the financial system. And of course, they're benefiting immensely from it because the big banks are picking up deposits left and right. Their power is gaining right now. So I don't think it should be that way. That's all. Thank you very much, Inflation Situation, sir. I appreciate the super chat very much and the support of the channel. All right, guys, we've been going an hour. I think we're gonna call it a day. I want to thank you so much for the generosity and for the super chats. I want to thank my Patreon supporters. You guys are awesome. Thank you for everything you have done for the channel, for the emails, the messages. I got people are spotting stories and they're letting me know on Patreon. Thank you guys for doing that very much. I really appreciate it. There is a link down below should you feel so inclined. Also, thank you to my folks on Discord, my Blue Wrenches, my moderators. There's been a ton of activity in the chat this week, and you guys have stayed on top of it and kept things neat and tidy in there, so I really appreciate that. Thank you, Mish. Bang up job this week, Mish, and last weekend. Get some rest. Have a couple of pints. You got anything you want to add, brother?
No, stay safe out there. It's going to get wild and woolly here soon, and be safe, man.
And guys, to reference a comment I got earlier in one of the super chats, it is true that hard times are ahead, but they are not here yet, all right? They're closer than they were. So stop and smell the roses this weekend. Enjoy St. Patrick's Day, if that's your thing. Have a pint. Get some rest. Spend some time with loved ones. Enjoy how good you have it because you will not have it that good forever. I think that writing is on the wall right now. So don't waste this opportunity to enjoy how well you have it. At the same time, start getting ready for what's coming. You don't have to go panic, but you can start preparing now. You'll be glad you did when it happens. And lastly, I want to say hi, Mom. Hi, Dad. I love you guys. And everybody, until next time, live small, and dream big.